In the realm of financial management, two prominent players exist: traditional banks and crypto wallets. While banks have long been the solution for managing money, the rise of cryptocurrencies has brought forth a new contender. In this video, we will compare banks and crypto wallets by examining their features, advantages, and considerations. When it comes to security, banks employ robust security measures, including encryption, fraud detection, and insurance against unauthorized transactions. Banks are regulated by governing bodies and adhere to strict compliance standards. Even though banks have established systems in place, their lack of transparency and lending practices, which utilize highly leveraged fractional reserves, make them much more risky than most people realize. Additionally, banks have control over customers' accounts, with the ability to freeze or restrict access to funds in certain situations. Crypto wallets, on the other hand, prioritize user control and security. Wallet owners have direct ownership and control of their digital assets, using cryptographic keys to access and manage their funds. The decentralized nature of cryptocurrencies ensures that there is no central authority with control over users' wallets. While this provides a higher level of control, it also places the responsibility of security on the wallet owner. Users must safeguard their private keys and take precautions to protect against hacking, phishing, and other security threats. Traditional banks have a long-standing appearance of accessibility. They have physical branches, ATMs, and online banking services that offer some financial services. With bank accounts, customers can easily deposit, withdraw, and transfer funds, as well as access additional features like loans, credit cards, and investment opportunities. However, just like crypto wallets, they move their money digitally. Crypto wallets, being digital in nature, offer enhanced accessibility. With a crypto wallet, users can access their funds and manage transactions anytime from anywhere, as long as they have an internet connection. Additionally, wallet owners can access a much larger and more diversified variety of investments, which in many cases offer much higher returns than traditional banks. Crypto wallets provide a user-friendly interface and support for various cryptocurrencies and make it easy for individuals to engage in the growing crypto ecosystem. However, it's important to note that while most barriers that limit cryptocurrency usage have been removed, a few still exist which are rapidly being dismantled. Banks are subject to Know Your Customer and anti-money laundering regulations, which require customers to provide personal information for identification purposes. While this helps prevent illicit activities, it also means that banks have access to customers' financial history and transaction details. This can compromise privacy and anonymity to a certain extent. Crypto wallets offer a higher level of privacy and anonymity. Transactions made with cryptocurrencies are not directly tied to an individual's identity. Wallet owners have control over the level of privacy they wish to maintain. However, it is important to recognize that some blockchain networks allow for transaction tracing, and certain wallet providers may require KYC verification, reducing anonymity in those cases. While we believe the role of banks will diminish over the next few years, to some degree, they still offer established security, convenience, and a wide range of financial services, while crypto wallets emphasize user control, accessibility, and privacy. The choice between the two depends on an individual's preferences, risk tolerance, and familiarity with cryptocurrencies. As the world embraces decentralized finance, it is unlikely that banks will continue to play such a robust role as in the past, and crypto wallets will fulfill more of a dominant role in the rapidly evolving digital economy.